Hey, what's up? It's Ryan with Planet Cheapskate, and I'm here to answer your question, what are the different types of mortgage loans? So if that's what you're looking for, I'm about to answer it for you very quickly. So just want to take a brief moment to invite you to subscribe to my channel. When you do subscribe, just hit that button to alert you whenever I release fresh content. I'm going to be doing a new series where I'm going to go through and ask common questions relating to mortgage, home loan, or real estate. So the first question that I have is, what's the different type of mortgage loans? The main thing to remember here is that there's two main types of mortgage loans. There is variable rate, which just means that your rate's going to change over the term of your loan, or there's fixed rate. Okay, fixed rate means that your rate's going to stay the same over the term of your loan. When I say term of your loan, I mean if you're going to do a 30-year, a 15-year, a 20-year, a 10-year, however long, that's referred to as the term. So two main types, variable and fixed. When you break down those, so many different products. Okay, there's variable arms, there's variable HELOCs. So on an arm, usually there is what's called a index and a margin. Okay, and so the index is going to be based off of, usually it's either like the LIBOR, or lately it's been what's called the SOFR. These are different exchanges that they are variable, that they use to adjust your rate. Fixed, which is most common, usually the ones that I do. I only really will do a variable if it just makes sense for a particular client. They're not going to be at the property very long. They want to maybe build some equity sooner. Or if we're in a market, which I haven't seen in my career, but if we're in a market where rates are super, super high and they're trending down, variable may be a safe bet. You do have caps that protect you in a variable rate to where your rate can't go up a certain amount per adjustment period and for the life of the loan. Fixed rate, which is probably 90% of the loans that I do. A fixed rate doesn't change. There's many different products. For the longest time, there was just really conventional products that you had to have 20% down. Eventually, the government got involved and formed these quasi-government entities, which is like Fannie Mae, Freddie Mac. I think there's one called Ginnie Mae, and there's a bunch of them. They just have special programs that help people get into homes where you don't have to do the 20%. You can do 5%, you can do 3%, you can do 3.5% down, just different products. But within the fixed and the adjustable, there's also what's called qualified mortgage or non-qualifying mortgage. And all that means is that a qualifying mortgage just means that it's qualified to sell to Fannie Mae, Freddie Mac, or these other entities that are quasi-government entities. A non-QM product just means that it doesn't qualify to be sold to Fannie Mae, Freddie Mac, these other government quasi-entities. Now, private lenders can trade them amongst themselves, which they often do, but they're not going to be like really 80 to 90% of the loans are, and that is qualifying to where they can basically be sold to Fannie Mae, Freddie Mac. And those loans have a certain standard that they have to meet. They can't charge you over a certain percent, and they can't be over a certain interest rate, and the costs are pretty much regulated. Non-QM is kind of a wild, wild west. There are still some regulations that lenders put on to protect you from predatory lending, but it's just not as strict as the qualified mortgages. So another thing about the fixed rate mortgages, the government came along and said, hey, we want to promote first-time home buyers, people getting into owning a home. And so they created products like a USDA product, which is a rural development loan. This just means, hey, we want to promote development in this area, so we will do a 0% down loan, and we will discount the rate a little bit, and we'll cover a little bit of the insurance on that loan, guaranteeing it for the lender to make it more enticing for them to lend money to this borrower. There are certain areas that you have to live in for that loan. Usually it's out in the country area or rural towns. Excuse me. There's also the FHA loan, which is typically someone who's a first-time home buyer. They may get this loan if they don't have the greatest credit, they don't have a lot of money to put down, and they just don't make a lot of money. They may utilize the FHA, which is 3.5% down, but there's often down payment assistance programs that can cut into that down payment. Now, without a down payment assistance or without a grant, usually you have to come with that 3.5, and there's no way around that. Any loan officer may be able to get you seller concessions, seller credit, lender credit to offset your closing costs, but they usually can't touch that down payment unless you get a down payment assistance or a grant. There's also VA loans. So if you're a veteran and you served your time and you made the sacrifice there, then you can qualify for what's called a VA loan. These are some of the best loans available. 0% down, your benefits cover your down payment. The government also guarantees your loan to the lender to make it more enticing for them to do it. And rare little fact here, VA loans are the least likely to not go through once they get approved. And so they're very, very solid loans. They're a great loan product. And if you have a VA buyer, you can rest assured that that loan, once it's approved, is going to go through. It has the lowest denial rate out of any loan product. So that is most of the different mortgage loans out there. There are HELOCs. There are a lot of different weird products. Like there's fix and flips products. There's DSCR products that are mostly for investors. But I would imagine you're probably out there looking for answers when it comes to your primary home. So that should give you the answers you need. Feel free to reach out, leave a comment below. I'll answer any questions you might have. And I may do another video that just kind of focuses in on investment type loans out there. HELOC loan, the main thing to remember about that is most of those are variable, and they are loans that you borrow against the equity in your home. They're very popular now because of the rate environment, because most people have like rates in the, below fives, and they don't want to refinance to pull cash out. So what they'll do is they'll get a HELOC on top of their first that will give them access to some of the equity in their house. So if you have any questions, anything, reach out to me. But I'm Ryan with Planet Cheapskate. Hopefully that helped you out, and have a great one. If you like this video, please like it, give it a thumbs up so more people will be shown this video. And if you liked it, please check out one of my other videos over here. I walk you through every step when it comes to buying a home, and over here, YouTube has determined that you may enjoy this video. Take care and best of luck.